All right, you know that sound. Today's closing bell at the New York Stock Exchange. The Dow Jones was all over the place after the collapse of Silicon Valley Bank, but it ended the day in the red, down about, there you see, 90 points. The S&P 500 and NASDAQ also closed relatively flat. CBS News business analyst Jill Schlesinger joins us here in studio. Jill, good to see you. A lot to talk about. So this bank failure, it's interesting, caused this drop in the markets last week. How did the federal intervention that we saw over the weekend and the president's comments stabilize things today?
Well, I think you just saw it in just the broadest indexes where they were up most of the day. I think there was a little profit taking at the end of the day, but really most individual investors, we don't really care about the intraday. But I think what really did happen is these two efforts by the Fed that were announced yesterday. One was, hey, any depositor at Silicon Valley Bank, at Signature Bank, if you had more than $250,000, we're going to make you whole. And that was one thing that was a really good thing to do for those folks, a lot of small businesses especially. Then the Fed also said we're going to provide some financing, some lending activity, a facility that would allow other banks like Signature and like Silicon Valley Bank, these types of institutions that are under pressure, they're going to be able to pledge their bonds that they'd purchased, get some free cash in case their depositors were actually needing money. Okay, those were really good. But what also happened today is the regional banks continued to come under pressure. The stock prices were down for those banks. I would say overall that the investment community is sort of watching carefully, trying to figure out, well, what's next? Have we staved off any contagion? Seems like we have. But still, there's a lot of uncertainty. And when we have uncertainty, often at the end of the day, we'll see a little selling.
So what about if you're one of these people who has their money in one of these regional banks? I mean, we had a small business owner on who said, look, I was over at the Chase opening up another account so that I could figure out how to get my customers' money and then how to write the checks myself, because she said we knew that our money was supposedly there in Silicon Valley Bank, but she said we couldn't actually touch it. We couldn't actually do anything with it. So what should people do for small
listen,
businesses?
If you're at Silicon Valley Bank or Signature, you can get your money today. So that was the good news, that at 9 o'clock today, you could get your money, you could write checks, everything was kind of on pace. It was scary not knowing that because, frankly, when it was 4 o'clock yesterday on Sunday, I think a lot of people did not know that, and it was nerve-wracking. I think for most people, we have to pull back and remind ourselves that there aren't that many individuals in the United States who have more than $250,000 in a single checking savings account, okay? Now, the ones that do, we would presume, we would call them wealthy, right? We have money, we've got more than $250,000 in the bank. You may not feel rich, but relatively speaking, you've got a lot of money. In that case, I would suggest that people always do business with an FDIC-insured institution and don't go over the limit. I think that for the businesses, it's a much different kind of learning moment here. And that is that doing business at just one bank can be convenient, but you really have to be careful and you really have to know, like, maybe I should be at a bigger bank. But a lot of people left those big banks looking for more service, more high touch, maybe not knowing what else they were doing and how they were managing their own bank.
It's interesting you say that because that's exactly what the small business owner said she was taking away from it, is the idea that having multiple places to have her business's money. That's sort of her lesson in this immediate moment. So the U.S. is still dealing with high interest rates, as you know, but financial experts say that the Fed might scrap its next planned hike. So why would that be, Jill?
Well, tomorrow's a big day. We're going to get a reading on inflation, the consumer price index. And, you know, we're still at 6.4%. Maybe we'll be 6.2% year over year as a price increase, okay? That's still really high. And I think if that number comes in above 6%, the Fed is going to be hard-pressed to stop their interest rate campaign. So rewind the clock back all the way to last week. Remember that? That's when Federal Reserve Chair Jerome Powell gave his testimony before Congress. And at that time, we were saying, oh, my goodness, they're going to raise rates not just one more time, maybe 2 or 3 more times. There is an issue with when you raise rates by so much, so quickly, there are unintended consequences. And the banking problems, maybe a little bit of those unintended consequences biting us, meaning that those banks purchased bonds, safe investment, U.S. government bonds. They were not slicing and dicing mortgages like 2008 and putting big bets out on the table. They were buying U.S. government bonds, but they were reaching for a little bit more of interest. And they did that by extending the actual maturity of the bonds they were buying. When you do that, you're taking risk that interest rates go up and your bond price goes down, which is what happened at Silicon Valley Bank. So I think one of the unintended consequences when you have interest rates rise is that you're pushing down bond prices. And in some cases, you are forcing companies to maybe sell those bonds before they mature because they need the money. It's not the fault of the Fed. It's actually not really anyone's fault because even Silicon Valley Bank, they were operating, I think, under the regulatory requirements, which did ease up back in 2018. They eased up on the small to mid-sized banks.
Yeah, but unintended consequences. I mean, I think a lot of folks are looking at what happened in 2018 and asking, why are there different rules now for these banks versus others? It's a question I'm sure that Washington people, lawmakers on Capitol Hill would be asking.
Absolutely. Okay, first of all, the thing to remember is that in 2008, we were on the precipice of disaster for this economy and for the banking system. After that, the Dodd-Frank bill meant that there was more supervision and regulation of the banking sector. What did that mean? It meant that there were specific rules about how much money or capital the banks had to keep on their balance sheets and also how much liquidity they needed to keep. And in 2015 or 16, small and mid-sized banks, led by Silicon Valley Bank, by the way, lobbied to have those rules eased up for banks that had less than $250 billion in deposits. Those rules were eased up. I would suspect an unintended consequence of all of that lobbying effort that actually did come to fruition is that under the Biden administration and under this regulatory regime, we are going to see stiffer banking regulations reimposed.
All eyes on Washington in the days to come. Jill Schlesinger. Jill, always good to see you. Thank you so much.
Thank you.